Okay, let's jump right in. Warren Buffett. You hear the name, you think investing legend. Billions build steadily over a lifetime, right?
That's the common picture, yeah.
But get this, a massive 99.8% of his wealth. It came after he turned 50.
99.8%. It's staggering.
It really flips the script on this whole get rich slowly idea, doesn't it?
Yeah.
Maybe it's more like get rich eventually, but then really rich later.
Huh, exactly. And that's really what we're diving into today, this power of time and patience in building real lasting wealth.
Because it seems so counterintuitive to the constant noise we hear.
Oh, absolutely. The world screams get rich quick, right? Buy this stock, jump on this trend, instant millionaire.
Yeah, that whole narrative.
But when you look at people like Buffett, or even someone like Jack Ma, I think the stat was 90% of his assets earned after 50, back when he was 55.
Wow, another one.
It shows this pattern, you know. Real wealth often takes a long, long time to compound significantly.
So we've been digging into this. We looked at some reflections from big names in business, combined with some fundamental investment thinking.
Right, trying to piece together the underlying principles.
And the goal here isn't some secret formula, obviously. It's more about giving you, the listener, a clearer sense of how wealth is actually built. And maybe, just as importantly, the kind of mindset you need for that long haul.
It's a marathon, not a sprint, as they say.
Definitely. So this power of patience,
Yeah.
Buffett,
Yeah.
Ma, they aren't just cool stories, are they? There's a mechanism there.
Not just anecdotes, no. They illustrate that wealth building is often non-linear. Like, it doesn't go up in a straight line.
Right, it curves upwards sharply later on.
Exactly. The biggest gains often happen way down the road once the foundation you've laid really starts to, well, compound on itself.
And that's tough mentally, isn't it?
Yeah.
We want results now.
It really is. We're kind of wired for instant gratification. Seeing those huge results delayed can test anyone's patience.
But it's not just about waiting around. It's about what you're building during that time. Like Li Ka-shing's CK Group.
Oh, yeah, that's a great example.
Over what, 46 years, 1972 to 2018, the market value went up 5,000 times.
5,000 times. Imagine putting in, say, 100 yuan back then.
You'd have 500,000 by 2018, which is incredible, but it also points to something else.
The importance of the starting amount. The principle.
Exactly. A 1,000-fold return is amazing, but 1,000 times a tiny amount is still, well, maybe not life-changing. You need enough capital for the returns to really move the needle on your life.
And that leads people straight into temptation, doesn't it? The desire to grow that principle fast.
Yeah, you see the potential. You think, I need more fuel for this fire, quickly.
Which brings us to those high-risk, high-return promises. The siren's call of doubling your money overnight.
But the catch is always there.
Always. Higher potential returns almost invariably mean a higher chance of loss. Significant loss, potentially. It's like a fundamental trade-off in finance. Very few exceptions.
And losing money isn't just losing money. There's this concept you mentioned, negative compounding. That sounds bad.
It is bad. It works against you mathematically. We love compound interest when it's making us money, right? Earnings make more earnings.
A snowball effect.
Negative compounding is the snowball rolling backwards and worse. See, if you gain 100%, double your money, fantastic. But then if you lose 50%...
You're back where you started.
Exactly. Or say you lose 33%, about a third. You don't need a 33% gain to recover. You actually need a 50% gain just to break even.
Wow, okay. That's not intuitive at all. The maths works against you on the downside.
It really does. So chasing those huge, multiple times your money wins in short periods. You're basically fighting probability and setting yourself up for these potentially damaging setbacks.
And it's not just the massive crashes, is it? Even smaller losses, if they keep happening.
They add up, or rather, they subtract significantly over time. We saw an example, I think. If you alternated between a 20% gain one year and a 15% loss the next, over 10 years.
You'd think you'd be doing okay, right?
Yeah.
More gains than losses.
But the actual total return is barely 10%, like less than 1% a year on average.
Less than inflation, probably.
Very likely. So these seemingly manageable losses can just erode your long-term progress. It's a serious drag.
This makes me think about psychology, how our own minds can trip us up. You hear about the anchoring effect in, like, shops with sale prices.
Right, the first price you see becomes the benchmark.
Does that happen with investing too?
Absolutely, massively. If your first big experience, or even just a recent one, was hitting a huge, quick gain, maybe you tripled your money on some speculative play.
You feel like a genius.
Right, and that big number, that huge percentage, becomes your anchor. Suddenly, steady, reliable, sustainable returns of, say, 8% or 10% a year seem boring, puny even.
Yeah, why would I settle for 8% when I made 200% last year?
Exactly. And that pulls you back towards taking excessive risks, constantly chasing that high. You forget or maybe ignore the fundamental rule. The most you can lose is always 100%. Past wins don't change that downside.
So it's a psychological trap. Those big wins can paradoxically lead to bigger losses down the line if you're not careful.
It's a real danger.
Okay, so high risk, high return, mostly avoid or be super careful. Are there any times it makes sense to even consider them?
Our sources suggested maybe two conditions. First, the potential upside has to be genuinely massive, like astronomical, not just double or triple, but dozens, hundreds, maybe thousands of times your investment.
So the reward has to be proportionate to the extreme risk.
Precisely. And second, and this is crucial, you have to be totally, completely, 100% prepared to lose all of that money, every single cent.
Like it shouldn't affect your actual life or financial security at all.
Zero impact. Think of it like buying a lottery ticket. You know the odds are terrible, the expected return is negative, but you spend a couple of bucks for the tiny chance at a huge payoff. It's entertainment money almost.
That puts it in perspective, not your serious investment capital.
Definitely not.
Okay, let's shift gears a bit. We're talking about building wealth. But what is wealth, really? It's more than just having cash, isn't it?
Oh, much more. The definitions we looked at frame wealth as assets that generate income for you without you having to actively work for it. Things that make money while you sleep.
Like what?
Think automated factories, software code that people buy or subscribe to, a large portfolio of stocks and bonds throwing off dividends and interest.
A rental property bringing in rent each month.
That's a classic example, yes. Or a business that runs effectively with a management team you trust. The key is that decoupling of your time from income generation.
So wealth is what buys you. Freedom. Freedom from the 9 to 5 grind.
That's a huge part of it. Freedom, autonomy, control over your time. That's often seen as the ultimate benefit of wealth.
And how is that different from just money or status?
Good question. Money is just the medium we use to exchange value. It's transactional. And its own value can go up or down, inflation erodes it. Status is more about your social ranking, where you sit in the hierarchy. And often, status games are zero-sum. For someone to go up, someone else might have to come down.
Ah, okay. But wealth creation isn't like that.
True wealth creation shouldn't be. It's about making the pie bigger, not just fighting over the existing slices.
So this idea that there's only a fixed amount of wealth in the world is just wrong.
Fundamentally wrong, yes. Think about human progress. We invented antibiotics, cars, the internet. Did that make humanity poorer?
Obviously not. It created immense new value.
Exactly. It generated abundance. Ethical wealth creation, often through things like capitalism when it works well, which is really just people freely cooperating and exchanging things they value, it generates new wealth. It benefits society.
It's the difference between makers and takers, perhaps.
That's a good way to put it. Societies that encourage creating value tend to prosper far more than those focused on redistributing or controlling existing resources without generating new ones. You need free minds and free markets, generally speaking, for ethical wealth creation to flourish.
Okay, so creating wealth isn't just about getting lucky then. It's something you build, something you become capable of.
Luck plays a part, sure, but it's not the whole story. The sources we looked at actually broke down luck into different types, which I found interesting.
Like what?
Well, there's blind luck, pure chance, like finding a winning lottery ticket on the street. Can't control that.
Right.
Then there's luck from hustling, just being active, trying things, meeting people.
Oh.
You increase your surface area for lucky breaks to happen.
Makes sense. The more you do, the more chances you have.
Then there's luck from preparation, being knowledgeable, having skills. It allows you to spot an opportunity when it appears, one that others might miss. You recognize the luck.
Okay, so being ready when opportunity knocks.
Exactly. But the fourth type was maybe the most powerful luck that finds you because of your unique character and reputation.
Ah, so people bring opportunities to you because they know who you are, what you stand for.
Precisely. Think of Buffett again. Deals come to him because people trust him implicitly. His reputation, built over decades of integrity and fair dealing, acts like a magnet for opportunities. That's not blind luck. It's earned.
That's a much more actionable way to think about luck. Build your reputation.
Build your character, your skills, your reliability. And interestingly, the sources also hinted that being a bit different, maybe even eccentric, can help. So, thinking differently, not just following the herd, can lead you to find novel solutions or opportunities that produce those abnormal returns we talked about. You can't just do what everyone else is doing and expect extraordinary results.
Right, you need a unique perspective. Okay, this contrasts sharply with the traditional path for many people, which is getting a job, earning a salary.
Yeah, the standard time for money exchange. And look, a job provides stability and that's valuable, but fundamentally,
It's linear. Your income is tied directly to the hours you put in.
pretty much, you work 40 hours, you get paid for 40 hours, you stop working, you go on vacation, you retire, you even just go to sleep, the income stops.
And there's a ceiling, usually. Limited potential for that exponential, nonlinear growth we saw with Buffett.
Exactly. Plus, many jobs, especially those based purely on time input rather than unique skill output, face the risk of being replaced. Automation, AI, outsourcing. It's a constant pressure.
And you're often not directly creating scalable value in the same way as owning a piece of a business.
Right, you're contributing, absolutely, but the direct link between your effort and massive scalable value creation might not be there in the same way as owning equity.
So what are the keys then? If renting your time isn't the primary path to wealth.
Ownership is a big one. Owning equity. That could be stock options in a company, starting your own business, investing in the stock market, owning a piece of the upside.
Having skin in the game.
Exactly.
Yeah.
And pursuing careers or fields where there isn't that direct linear link between input hours and output value.
Like a software engineer example versus, say, a lumberjack paid by the hour.
Right. One engineer can write code that serves millions, potentially generating huge value far exceeding their hours worked. The leverage is different.
And the personal finance side.
Still crucial. Living below your means is fundamental. Avoiding that trap of lifestyle inflation where your spending just rises to meet your income no matter how much you earn.
Keeping that gap between earning and spending so you have capital to invest.
Yes. And aiming, if possible, for income that comes in larger chunks rather than just a steady paycheck. That can give you more flexibility and freedom to make bigger moves.
It keeps coming back to value creation, doesn't it? Serving society somehow.
It really seems to be the core principle. The sources suggest wealth ultimately flows from giving society something it wants or needs, often something it doesn't quite know how to get yet.
And figuring out how to deliver that at scale.
Exactly. Money, then, is like a certificate of appreciation from society for creating that value.
Look at history's big wealth creators.
Right. Oil pioneers. Henry Ford making cars accessible. Steve Jobs with personal computers and smartphones. They identified a massive need or desire and scaled a solution.
So the entrepreneur's job is to spot those gaps, build the solution, and then scale it up. Like Jobs seeing the potential for a user-friendly computer.
Or even something like Uber taking an existing service, taxis, and using technology to make it radically more accessible and convenient for millions. Scaling a better solution.
And today, the internet feels like the ultimate scaling machine for this.
Oh, absolutely. The internet is revolutionary for wealth creation precisely because of that global connectivity. It's unprecedented.
How does it change the game?
It allows you to find an audience, a market for almost anything. No matter how niche your interest or product is, you can likely find people somewhere in the world who care about it.
So you're not limited to your local area anymore.
Not at all. And it creates entirely new ways to build a brand and earn a living. Think about professional gamers, YouTubers, podcasters, bloggers.
Careers that didn't exist 20 years ago.
Exactly. And in this crowded digital space, authenticity becomes really important. Being uniquely you is how you stand out. Trying to copy everyone else means you're just competing directly. Your unique perspective finds its own audience.
It allows you to scale your obsessions almost.
That's a great way to put it.
Yeah.
Someone deeply obsessed with, say, a specific historical period or a type of craft can now potentially build a global following and a business around it online. It's amazing.
It just broadens the definition of what a valuable skill or interest can be. Playing Fortnite professionally, Joe Rogan's podcast, PewDiePie.
All examples of leveraging unique interests and skills at internet scale.
So again, it comes back to playing the long game, building that audience, that value over time.
Definitely. It ties into the idea that almost all the real returns in life, whether in relationships, knowledge, or money, come from compound interest, playing long-term games.
How do long-term games help?
They build trust. When people know you're in it for the long haul, they're more willing to cooperate, invest, and build things together. Compound interest works best over long periods, and so do relationships and reputations.
Like Silicon Valley's network effects, people trusting each other over many ventures.
That's a big part of its success, yes. These dense networks built on repeated interactions and long-term
Ah.
trust. Or think about why Buffett could invest so successfully in the U.S. market for decades. Relative stability allows for that long-term compounding.
And these long-term games tend to be positive sum. Everyone can win together.
Ideally, yes.
Yeah.
You're focused on creating more value, making the pie bigger, rather than just fighting over scraps and short-term zero-sum interactions.
Choosing who you play those long games with seems critical then. Your partners.
Absolutely essential. The sources were clear on this. You need people with high intelligence, high energy, and above all,
Integrity.
integrity. Non-negotiable, because without it, intelligence and energy can be actively dangerous.
And you want people who are intrinsically motivated, doing it because they care, not just for the external rewards.
Yes, that passion keeps things going through the tough times. And you need to look at actions, not just words. How do they treat people they don't need anything from? Are they fair? Are they trustworthy?
Like the old watch how they treat the waiter test.
Exactly. Look for people with high ethical standards, people who value their reputation with themselves. They tend to be the most reliable long-term partners.
It takes a certain mindset to stick with this long-term approach, especially when things get tough. This idea of rational optimism came up.
Yeah, that was interesting. It's not about blind optimism ignoring problems. It's about seeing reality clearly, warts and all.
But still believing you have the agency to make things better,
Yeah.
to build solutions.
Exactly. Pure cynicism can be paralyzing. It stops you from even trying. Rational optimists acknowledge the challenges but focus on finding pathways forward.
Is pessimism just outdated?
Well, maybe it was a useful survival trait historically, being cautious, assuming the worst. But in modern society, with more safety nets and opportunities,
Optimism is maybe more beneficial for seizing those opportunities.
arguably, yes, especially this rational optimism. It allows you to take calculated risks with big potential upsides, while carefully avoiding anything that could lead to total ruin. Think Elon Musk betting big on SpaceX and Tesla, but probably ensuring he wouldn't be personally wiped out if they failed initially.
So acknowledge the risks, but don't let them stop you from building.
Right. Respect the possibilities. It's a builder's mindset.
And to build effectively, you need more than just optimism. You need specific knowledge. What exactly is that?
Specific knowledge is the stuff that's hard to teach, hard to quantify, often learned through experience or driven by innate talent and passion.
Not something you can just get from a textbook or a standard course.
Generally, no. If it can be easily taught and standardized, it can likely be automated or outsourced eventually, which limits its long-term earning potential.
So what does it look like?
It could be deep expertise in a niche field, unique creative talents, exceptional judgment honed over years, strong intuition about people, maybe a combination of skills, like someone who understands both psychology and sales deeply.
Stuff that feels like play to you, but looks like work to others.
Often, yes. It comes from pursuing your genuine curiosity and passions, not just chasing whatever trend is hot right now. It's learned through apprenticeships, through doing, through figuring things out.
Like Buffett learning from Graham.
Perfect example. Or think about highly skilled meme creators today, or someone like Scott Adams combining cartooning with business insights. It's often technical, creative, and on the cutting edge.
So find your obsession, build real skill in it, and then figure out the commercial angle.
That seems to be the path to developing truly valuable specific knowledge.
And once you have that knowledge, or while you're building it, there are two crucial skills. Learn to build, learn to sell.
The unstoppable combination, according to our sources.
Build means actually creating the thing, the product, the service.
Yes. Design, development, manufacturing, coding, writing. Whatever it takes to make the actual value proposition.
And sell.
That's broader than just closing deals. It's marketing, communication, raising capital, recruiting talent, persuading people, public relations, getting the built thing out into the world and getting people to embrace it.
You often see successful startups with two founders covering these bases.
Right.
One tech genius, one business sales lead.
Classic pairing. Apple, Microsoft, Google. Many started with that complementary dynamic.
But the ultimate goal is maybe to be able to do both yourself.
That seems to be the pinnacle, yeah. Individuals like Musk, Jobs, Ellison, they often develop strong capabilities in both building the vision and selling it, though it's often said it's easier for a builder to learn sales than for a salesperson to learn deep technical building.
Interesting. Okay, so bringing this all together, it feels like a very different picture of wealth creation than the lottery ticket mentality.
Completely different. It's long-term. It's about patience, avoiding disastrous losses from chasing quick highs, focusing on creating real value for society.
Leveraging new tools like the internet, developing that specific knowledge that feels like play, being rationally optimistic.
And mastering those core skills of building and selling. It's a much more grounded, sustainable, and arguably ethical approach.
It really is a comprehensive framework.
Yeah.
It emphasizes the journey and the mindset as much as the outcome.
Exactly. True prosperity, as these sources suggest, is likely about more than the final number in an account. It's about the freedom, the impact, the process itself.
Which leads us perfectly to our final thought for you, the listener. Thinking about everything we've discussed, what does true prosperity actually mean to you? Is it just a number, or is it something more? How do these ideas about long-term value creation, specific knowledge, and rational optimism fit with your own definition of a truly wealthy and fulfilling life?
Something to ponder. We hope this deep dive gave you some valuable perspectives.
Definitely. Chew on that, and we encourage you to keep exploring these ideas.